fundsupermart.com.
So I just want to start with your outlook. Where do you see the Asia Pacific property market going for 2012 and going to 2013?
Okay. Well, I suppose Asian property equities have been in something of a sweet spot. And we anticipate that this will continue for three main reasons, I suppose. The first is valuations. We're trading at about a 20% discount to net asset value. So you're able to get exposure to companies that own assets like Ion Mall, Marina Bay Financial Centre, at a significant discount to what they're really worth. So that's always attractive. The second point, I guess, is really on the fundamentals, which have continued to be very strong across Asia. If you look at the residential market, whether it's here in Singapore, Hong Kong, China, and even Japan, sales have been well ahead of expectations, and we think that that will continue. And even for retail, which is often seen as a difficult sector at the moment, we've seen retail sales growth of up to 10% in certain markets across Asia. And then the third point is really on news flow for the sector. We think that people are going to continue to want inflation-linked yielding assets, and that will provide a tailwind for our space.
Okay, so I mean, you've mentioned a lot of factors about the sweet spot, but in terms of actual catalysts that could drive performance higher, what are some of the positive factors you see that could push the performance of Asia Pacific properties?
Well, I suppose the recent actions by central banks, if you look at the ECB and their comments to do whatever it takes, which is pretty strong, powerful language, coupled with the Fed on the recent round of quantitative easing, then I guess these provide two, I suppose, salient points. One is, or the first point is, that it means that interest rates will be lower for longer. And the second point is that it will force people up the risk curve, or it should in theory, force them to move from safe havens such as cash and bonds and into equities. Both of those drivers are incredibly powerful for the Asia property equity markets.
Okay, but what about the flip side of the coin? What are some of the risks as far as it comes to Asia property markets?
Yeah, I mean, because we are in a global market, then we have to think about things outside of Asian property. For example, what's going on in Europe, the US, and also potential slowdown in China. The central bank's actions reduce the tail risks in Europe and the US to a certain extent. But whilst those have been reduced in the last couple of weeks, if anything, the risks have been increased from a political standpoint when we look at tensions between China and Japan, and also in the Middle East. Within the property space, our key concern is always policy risk, and we have seen that increase recently, both in Hong Kong in terms of policy measures for residential markets, but even here in Singapore, where we've seen some measures related to the shoebox apartments.
Okay, so talking about Singapore, how attractive is Singapore, especially when compared with other Asian property markets like Hong Kong or even Shanghai?
Our view is that Singapore will remain an attractive destination for investment given its open, transparent economy, but also because of some other key attractive features. In particular, if we look at the residential market, the rise in prices has been relatively muted, which is a good thing. We've seen sales so far this year at about 15,000 units, which is well ahead of where we were last year. But yeah, we think policy risk is relatively low within the Singapore residential market. And if we look towards the REIT space, you're still able to get an attractive dividend yield. At the moment, it's probably around the region of 6%, which compared to other asset classes, such as bonds or just having your cash in the bank, is particularly attractive.